I see it as a warning sign. I see it as a warning sign. You know, Kelly, they have a well-earned reputation, as you're well aware, of Dow Transport theory of predicting the economy, but that comes from the underlying goods flow. And the bottom line is, starting really in December of last year, we began to see signals first in international air freight. You saw the warning out of FedEx in December of 18, and then and the CAS shipments index.
Right.
And we've seen that increase since then. The goods flow is negative, especially in Europe, accelerating negative in Asia, and it's getting weaker here in domestic.
So it sounds
and the
a
bottom
little
line
bit...
is if you lower volumes, it suggests that the Fed is not only right to be cutting rates, but they're late to the party.
Sure, and you're kind of the missing link then in this whole discussion that we're having about how weak the U.S. economy is. But I would just ask, when we talk about a slowing, how much of a slowing are we talking about? A lot of folks still seem to be in the mindset, Donald, as you're well aware, that every slowdown means we're going back to 2007, 2008. Can we take a hit in terms of activity and have it just look what happened in 2016? I mean, we've seen these soft patches in this economy before.
You're right. Absolutely, you're absolutely right. You have to put it in context. The severity, the magnitude of the slowdown is important to look at. And in some areas of the economy, most areas of the economy, we're seeing down single digits, down mid-single digits in the domestic economy. But there are some areas that are just quite alarming. You know, we're seeing over 15% down in the air freight volumes going into Shanghai. And you say, well, why is that a problem? Well, that's all the parts and pieces that get assembled and they get shipped out. And that's the predictive indicator of what Asia-Pacific overall air freight's going to be. So when I see those kinds of numbers, I get really nervous. Domestically, the amount of lumber we're shipping, the amount of chemicals we're shipping, the amount of autos and auto parts we're shipping all suggests slower times. If I look at truck volumes in real time on a platform like you get out of FreightWaves Sonar or out of DAT's load boards, you can see real time what's happening. And June was a little bit better, but June ought to be better. It ought to be the strongest freight month for trucking seasonally. And, it's still down. Second quarter volumes were still down on a year-over-year basis.
I don't want to let you go without getting a couple of recommendations here. Maybe the Fed is looking at these data, and that's behind what they seemingly plan to do. You like FedEx
I know a number of them do.
I bet they do. Why wouldn't they? FedEx and XPO are two picks that you like long, but you say the best pick for the second half in transports would be short the truckers. Why?
Well, we like the XPO and FedEx because, one, their valuations already reflect what we're talking about. They were early to warn everyone about it. And they deliver e-commerce, which is going to grow. Even in 2008, e-commerce grew at 14%. So in a bad year, it only grows mid-teens rates. That's not a bad business to be catering to. Truckers last year had a magnificent pricing power like they've never had before. And they passed most of it on to their drivers to compete in a tight labor market. That pricing power is eroding. It's going down as significantly, almost as significantly now as it went up significantly in 18. But those costs aren't. You can't cut those driver pay.
Once you've raised them, you can't cut them. You really can't cut them.
So if we see lower volume and lower pricing, then that's going to be lower revenue and much lower margin on that lower revenue. And the stocks, unlike FedEx and XPO, who have already been taken out behind the woodshed on a valuation basis, the truckers are down, but they're not down anywhere nearly as severe.